I would just want to say that financial excellence itself, I wouldn't say it's a very fun topic, more than dry, but let's try to keep it as sexy as possible today, and fun for the audience. I think we have a great lineup here today, with Paul Becker from Recap, Arnd Schwierholz from N26, the CFO, and Nagel. Nice to have you guys here. Before we get into the topics I've prepared, let's maybe start with a little introduction round from you guys with a first question. Christian, maybe you want to start. What interests me the most is you've talked to, I would say, thousands of founders on your journey, also regarding financial excellence and the, I would say, educated level itself. Is there a lack of financial excellence for first or second time founders when you talk to them, and is it bad?
I would say in general, yes. I think it would be better if you were very aware of what you're doing and about your financials, because in the end it's about scaling a company, and if you don't have this basically fully under control and really up to a good level, then it's just hard to get follow-on financing.
Mm-hmm. So is it bad, or is it something that is okay for now and has to be worked on?
Well, I think it really depends a little bit on the phase. I mean, you don't need to have this initially basically as a founder in yourself, but you need to find someone who can help you and support you.
Mm-hmm. And maybe let's get back to you. When it comes to 10 to 100 scaling or 100 to 1,000 scaling, let's say, we are here at the One2Hero event. Is there a very, very big difference regarding financial excellence when it comes to 1 to 10 scaling and 10 to 100 scaling?
I think there is, and I think at the beginning it is getting through, making sure that you start a business model that works, that has proper unit economics, whereas obviously functions like finance take a backseat. You want to make sure that you have accurate data, but it's not key. Key is you want to have a product, you want to market it, you want to understand how it works, how unit economics work. And then after a while, you start seeing that you're getting more and more repetitive data. You do a monthly closing, you do a budget, you do accounts receivable, payables. You want to get into a more standardized procedure that probably starts somewhere at let's call it the 100 employee type of mark. And as you go along, you get more and more professional, you get more and more into reporting type of things. Mm-hmm. So yes, there's a big difference. The beginning is, let's get started. Let's make sure you have a business. And then at some point you want to get more and more professional.
Okay. Paul, what I found very interesting and having you on the panel here is you've seen so much data in the last few years with Recap, and based on the experience and the quantity of cases you've seen, what kind of patterns do you see mostly from the startups and companies that are being onboarded on the platform?
It's tough to say if there is like one thing that you see with all the companies. Maybe I would frame it a bit like commenting on what you just said. I would generally confirm that the more mature companies also tend to be more professional when it comes to their financial stack and how they manage it, and we can certainly see it. The easiest check is probably, can they actually provide the data in the first place? This is where many companies fail. However, what we've also observed is we are not just working with VC-backed companies, but also with bootstrap companies, is that bootstrap companies by nature need to be more financially literate early on, because they don't have like a big pile of cash in their back and live from it, and are forced to think about that more early on. And there I would say that also in the early stages you see more professional behavior when it comes to finances.
Okay.
Maybe to this point, I think also the times have changed. 3 or 4 years ago, it didn't matter too much in the end because everything got financing, It was a good idea. financials, okay, we will get there. So this has changed a lot, at least for us. It changed a lot, and we see this also in follow-on financing, that now it matters much more in terms of you really have to be on top of your financials nowadays. Even in the quite early things, as soon as you start basically generating revenues, if it's a SaaS model, generating MRR levels, you have to have your finances and the KPIs in order. You have to really be on top of things.
Mm-hmm. So based on the trend, that's something maybe the audience can take away, and the people also listening to this live podcast here today is having their KPIs and fundamentals ready to go every time. Right. Maybe let's get back to the first big topic that interests, of course, the most of the people and goes to the bridge of talking about health metrics. What for maybe you, Arnd, is like one of the key health metrics you look at N26, and also like, of course, from looking back at your career at Flix, for example?
Regardless of N26, a little bit on especially if you're an early founder. I mean, rule number one is your cash runway. You want to make sure that you have enough money for everything that you're planning to do, and don't get distracted. P&L sometimes looks different than your cash flow planning. So especially in the early days, it's important to have a good overview on money in, money out. I think as you move along, and probably easiest to understand if you have sort of a P&L in front of you, what I said earlier at the beginning is make sure your business model works, your unit economics work. Then at some point you start questioning yourself, how efficiently are you acquiring customers? You start looking at customer acquisition costs. You'd start looking at lifetime value of a customer. So you want to make sure not only that you have a functioning business model, but there's efficiency in the way that you are acquiring customers. And then at some point in a later stage, you want to see what your bottom line is. So you start looking at your EBIT or your net income, trying to make sure that you got scaling, economies of scale, make sure that you have non-scaling costs under control. So you go more into that optimization. But I think rule number one, what's your cash runway? And then you start looking, depending on maturity of your company, what is sort of your key metrics in the P&L.
Would you share what kind of metrics you focused on when you took the role at N26 maybe? What were like the key health metrics you looked at?
Well, I think I go back a long way. I've been a founder at the turn of the century, which is probably more has probably more resemblance to what the audience is having here. And that was exactly what we did. We looked at cash in a predominant way. I think if you look at financial institutions like N26, it becomes a bit more complex. You start looking at balance sheet metrics, how much equity is in, and how is your asset and liability side structured. So there's a greater degree of complexity in there. But I think important, especially when you start early, make sure you have enough cash.
Okay.
We can see Christian nodding.
He's just smiling already. Yeah. Yeah, absolutely. I mean, this is key. This also has changed a lot. A couple of years ago, 2021, nobody was talking really about cash, yes, but the cash, nobody cared about how long it would last. It was okay if cash would last 9 months or 12 months, it would be fine because you would be raising anyways 6 months later. It has changed. Now, suddenly everybody wants to know, okay, how do you reach profitability? When do you reach profitability? How much money is needed to reach profitability? Can you maybe do this with the money raised? So these kind of discussions are basically happening every time with every investment we look at, and with every follow-on route we also basically are involved. And this has also changed. This hasn't been the case before. Will it come back? Many people say that it will not come back, but it will come back. I'm very sure it will come back, but we are not yet. That's true. That's why it's really important. And if you build your business and start ramping, you really need to make sure that you have all these things basically in a good shape, in that sense that you take care of this. And also, if you ramp your business, you really need to always need to be prepared in terms of rather basically prepare for longer cash reach, or the way to reach profitability without a follow-on funding, potentially, which is in some cases hard. With the SaaS business, it's possible. With the deep tech business, it's not possible. But then make sure that you reach your milestones, which are really value creating, so that you can raise based on that.
Okay, good one. Question, if I may, comes up in quite a lot of situations. One thing that is always under discussion is, when do you start raising new funds? In the old days, you said as late as possible, assuming that you increase your valuation over time. As well, what Christian is saying is probably get a bit of a cushion, even though it might come with higher dilution in the beginning. But that cushion, and I mean, it's happening probably with every startup. Not everything goes perfectly well in the beginning, so you want to have a bit of an extra to cover the surprises that you might see on its way. So I guess every founder needs to ask himself or herself, when is a good time to raise cash? How much cash do you want to raise? And what kind of dilution are you accepting in that regards? And at the moment, it seems to be more on the conservative side than maybe in other times, where it was always clear you get funding, and the more maturity you can show in the company, the higher the valuation, the lower the dilution that you need to accept.
Yeah. Paul, you were about to make a point?
Yeah, and in general, I agree with what both of you said, that the metrics you should look at and what you should be focusing on changes throughout the life cycle of a company. But what I would reiterate here is that this certainly also means that at a certain point in time, you do not need to deliver it all. I oftentimes see founders who read certain guides where they see benchmarks for certain metrics, like, for example, customer lifetime to customer acquisition cost ratio needs to be at least 3-to-1 or better. And then people think, oh, I don't have that. Do I run the wrong business, or do I do something wrong? And my view on this would always be like, there is a time where you should deliver on this, and maybe the time is not right now, and then it could be okay if you enter a new market. Currently, acquisition is still very inefficient and expensive, and that's part of the game, and it's fine. Nobody will blame me for that. So that's one point. And the second is, next to changes throughout stages, one obvious thing is obviously it depends on your model. Like we, for example, work a lot with subscription-based companies, SaaS companies specifically. And if I would pick like one metric we care most about, and we only work with companies that are revenue generating already, that one metric would be net dollar retention. When it comes to financial health, this is like for the stages we look at, which is typically like Series A to B, C-ish. What we care most about, it tells me like, is revenue quality at a decent level or not? And if it's not a good sign.
When it comes to recapitalization, and what kind of funding options are currently, when you look at the market trends, the most attractive for a startup, fast-growing, let's say tech-based startup? Just a question to the round. Will, what's the answer?
I think the healthiest is, but that's probably hard to achieve, is the internal profits that you're generating. Obviously, at the beginning, super hard, but there are probably situations where company asks themselves, should I bootstrap in order to give them more time on getting a product out. I think the other options, clearly equity, and that comes with a question of dilution, and do you want someone else on the cap table that is trying to get into your strategic, or how you run the company. I think there are other options around debt, and probably in early stages, probably more the vulture type of debt, which is expensive. It probably is double-digit on percentages, and other than equity, it requires a cash payment, an interest payment if it's not a bullet. So there will be cash outflow, whereas with equity, obviously, there will be only cash at the exit.
Mm-hmm.
I would actually challenge one point that you make, or show off the limitations of it. Like in practice, again, for SaaS companies, what we oftentimes see is that they, for example, go for annual upfront payments, which is seemingly an easy way to generate more cash, like from the business you're doing. And for some cases, the discounts that you need to give to companies are actually higher than if you are a profitable company, than the annual interest rate you pay for a loan. And this is something we've seen more than once, where a company actually followed that thinking, like, the cheapest money I can get is coming from my customers, and not thinking that a discount is in essence actually also cost of capital, right? In general, I agree with that, but it's like an interesting thought experiment that many first-time founders actually don't realize.
I had a great chat, or maybe you and I had something to his point. Otherwise, I would just add something. I had a great chat with someone talking about debt funding and how common it's been seen here in Germany in comparison to the US. And debt funding is in the US kind of more common than Germany, it turns out. Do you agree with that?
Not in general. I mean, it really depends on where you are in your journey and your company life cycle. If it's very good, we've seen some companies taking up venture debt or kind of other debt forms too early, not ready to ramp really, not basically having a stable SaaS business on which you can basically raise and also pay back and pay interest. So that's something where we've seen many cases which we have struggled due to that point, being not ready basically for any kind of debt structures. Can be different debt structures, but any kind of debt structures. So then in these cases, you have to take venture capital, or you are self-funded. Then obviously you need to have the choices to do whatever you want. But if you're not, then you have to look for venture capital. And it's really important to see, okay, at what point in time are you ready for debt financing? So you have to basically obviously you have to have a cash generating business, and not just cash generating business, but it has to be also basically foreseeable somehow. So you have to be predictable in a certain way. Only that it makes sense, because if you're basically dependent on something, or something can happen, which you may know, then you may not be ready to take up any kind of debt structures.
Yeah, I agree with that. And in general, well, what we always tend to explain to founders and CFOs is that it's a question of risk or certainty or predictability. If you have low risk, high predictability, then that could be a good option, because generally it should be cheaper. On the other hand, if risk is high and you don't know what's happening, like you build a new product, you don't know if it will actually ever get to the market or make revenue, then you should probably go for equity, because it's more stable, more secure. You don't need to repay it, but it's more expensive. I mean, you're selling a part of your company, right? And it's gone. That's something that people tend to forget when you talk about cost of capital. It's sometimes like, yeah, a loan costs money, equity doesn't. That's not true.
Yeah, sure. Then maybe to make a last point there, are there like financial like blind spots that you guys see when it comes to, of course, collecting capital, either if it's debt or equity, but also in general when it comes to like retained business, SaaS solutions, where there's like an income that's currently retaining every month, every other month. So basically, yeah, are there blind spots that mostly founders don't see?
Well, if you made the point in terms of comparison to the US, I think the venture debt and the debt availability and options have increased quite significantly. So I would say 15, 20 years ago, there were hardly any venture debt players around Europe. This has changed to the much better in the end. So different options, helped by also from Paul and others. So this has changed a lot, and that wasn't the case back then. But I would say now, in this respect, there is can never be enough. But we always like to have more options. But at least there's a good liquidity available now. Biggest issue we see in general in the ecosystem is the growth capital, the availability of growth capital. So that's still an issue that has been an issue for a long period of time. So we see gap between the US and Europe, factor 5 to 6, basically less capital available. But you can make the math per capita in the end. That's probably the best way to see this. Factor 5 to 6 less growth capital available, US compared to Europe. And that obviously haunts us in terms of how quickly can we scale a company, and we have to rely on the use money coming in. Nowadays, it's not coming in to the extent it has been coming in 3-4 years ago.
Yeah.
But so that's why we would need more capacity, European capacity, to also provide growth capital for later stages.
Christian, on that, like there are many people like yourself, but Klaus Onno is, for example, one of the most vocal people who talk about the lack of growth capital. Why do you think? I mean, we are talking about this for 10 years already. Why is it so hard to change? Like, is it not possible to sell this to LPs? Don't they want to allocate more in Europe? What is the limitation there?
Well, in the US, 67% of the venture capital comes from, which invest into funds, comes from endowments and pension funds. And given that we have different pension schemes, at least in Germany, not in all European countries, but we have it, and the endowments are restricted. And also the pension funds, they are also the ones we have, they are also restricted in terms of investing into this asset class. And this has been ongoing for, as you said, for a very long period of time. This is the issue we have here in Europe, the structural issue. Now it is slowly changing, but only very slowly changing, so that we can see the real effect. And if we grow, it's not that the amount of capital in the US is on the steady state. It's also growing. So that's why this gap is not widening, but it's not closing.
Talking about solutions, maybe on the second part of this discussion here, before we go into the Q&A, regarding solutions, regarding financial setup for companies, what is like too much rigor for, I would say companies in a more scalable phase on growth level, and what is too much of a hassle to have as setup when it comes to software for finance?
I can maybe comment on early stage first, and would absolutely agree with what you said earlier. The bare minimum of what you should have is like accurate tracking of your cash balance and runway. There is like no way you cannot have this. And if you just have one bank account, then go for an export and get yourself a little Excel tool and import it in there. And that's like, I would say the bare minimum. Like when it comes to tools, I'm obviously biased instead of going for
asking into the round and not yourself.
Absolutely. You can also just connect your bank accounts to our platform, and there are other players like ourselves who, for different stages, offer good solutions. I think it depends, and maybe you can share more insights on that in a second, how this changes over certain stages. What I can certainly say is that the solutions that we, for example, have in place fit very well for micro and small SMEs. But when we talk about this, like with medium-sized and larger companies, the degree of customization they expect, we can't offer that right now. And then there are other solutions who only do that, but then you need to invest like a month of time and customization initially, which would be a deal breaker if you're still in the very early stages, right?
And absolutely, I tend to agree, especially at the beginning. Simplicity matters. You don't want to be stuck in ERP systems that you don't understand, and then you spend more time on processes and tools than on actually data, where you shouldn't compromise with the quality of data. So you need to be, besides the cash runway, you shouldn't build a backlog of invoices that you haven't paid, and then you get surprises or you're not billing your customer correctly. So the data quality really matters, and that's where you need to have good control, not only in the finance department, but also in the operational departments, and have that good control of data. I think systems can come at a later stage. And if you feel you don't have the right team in place, they are outsourcing solutions, not only for tools, but probably for headcount as well, where you rather say, let someone else do the bookkeeping, make sure you have the data in time, rather focus on your business. And as I said earlier, the quality of data, make sure they are, you really know what's going on in the company. That has more value than running a system.
Yeah, Christian, maybe based on the verticals from Earlybird,
looking at the startups that you work with, what is like common for the financial setup when it comes to software?
Well, I think it really depends what you're up for. I would say so. There's nothing what you I would say it's nothing specifically I would say or could recommend here, because there's so many tools out there. Nothing where I would say when you have to have this. It really depends on what kind of business you are, which phase you are. So it really depends. But there's nothing I would say, well, this is it. But at least there are enough solutions out there which haven't been available for a couple of years ago.
Yeah, but I think to make the point clear, I think what everybody has to look at is how much time they spend on developing the system, developing the setup of the financial tools and how they are integrated in each other, rather than working on the company itself and like growing actually. Yeah, definitely. Maybe to get to, or before we go to the Q&A, I was thinking about a great question to all of you guys. And what would you say, based on your individual career, would be the best financial advice, looking just individually back at your career?
I think that seems to be a tricky one. And I don't have a super good advice. I think the only thing that I learned in life and in the career is it's not a sprint. It's rather a marathon. So we tend to look at what's happening next week and to the next funding round, but it goes on and on. So make sure you set up yourself in a way that you can endure a marathon, i.e. get the right people around you that carry you, get the right kind of talents together that complement each other. Ask yourself the questions, are you still doing the right thing? Is it time for a pivot? If you decide so, be decisive. Or if you consider you think you should be doing it, then do it, and do it in a consequent way. I think those were a few things that at least I have picked up.
Awesome. Christian?
Yeah, always take the money when it's offered to you. So, well, obviously at any conditions, but if there's money offered to you and you already have raised something, there's somebody coming, you would take it. Just take it, because it's good to have this buffer. I mentioned this at the beginning, rather have more buffer than less. And if it's offered, there are times where it's not offered. And if in other times it's offered, take it.
Okay, Paul.
It feels so wrong to now have a contrarian view to that, but I would actually say think about when to take money and what type of money. When I think back to when I started my first company, I was just happy if somebody would give me money, and I felt like this is so great. Somebody is believing in my idea, and I didn't think about what I pay for this, if this is actually the right fit, if I want to work with that person, if I actually want to embark on a VC trajectory. Like, it's a big question. So many founders ask you, like, what is the best VC to raise from? And then sometimes you just ask them, do you actually want to raise from a VC? Is your model the right thing for a VC? So I would just encourage everyone to think early on about the capital needs of your company and trying to understand what type of funding tool is the right for you, and then thinking about who's a good partner and so on.
Awesome. Okay, I would say let's jump to the Q&A, something that I always really like, because then we can ask far more individual questions than we do here on the panel. So I would say we would get one mic. I can bring one, maybe one of yours, because then I can moderate still to people that are possibly raising hands now. So we can go to the Q&A now. It's always hard to be the first one, but there are no bad questions.
Hello? Yeah, perfect. Arnd, I believe between equity and debt, you're probably the most neutral person here, because you've probably used both in your past. Like, if we look at a company that has been VC pilots in the past, so there's a certain cap table and they're approaching profitability, so metrics are picking up and the company's generally functioning, maybe not the crazy rocket ship. When do you think it's fine to dilute and accept to for the reasons of raising extra cash accept dilution, and when do you try to avoid dilution? Like, what should be the use case for debt versus equity?
Well, I'm not sure that I can really give you a good answer on this one. But as a gut feeling, I wouldn't raise debt too early, just as it comes with certain limitations. Usually you wouldn't get debt without any covenants, especially in the beginning, any types of guarantees. So making sure you hit your annual payment, especially in times when you're still early in your curve, and there are a lot of surprises coming. And as I said earlier, it's never a straight line. So be aware of that there might be surprises. I think from my taste, it becomes a bit more interesting once you have more stability, visibility, and you get into a mix of, is it equity and debt? Can you use debt as a bridge type of funding? A little bit what Paul said earlier. Do you have special access to debt if you are more of a hardware type of company? Can you do some kind of asset financing? Can you play with your accounts receivable in a way that you get them into cash? In my taste, I would do it rather later. There's always the in-between, which is the convertible structure, where you say we can't really agree on a valuation, and that goes into dilution. So you take the money, but you take it to the next real valuation event that you're creating. Sometimes that helps, especially in situations where there's uncertainty on, is it already a mature company? Can you really value the company? You have a huge spread. Then you probably can think about that convertible to bridge you into the next round. But my taste would be, even if it's expensive, look for stable funding in the beginning. Stable would be, even though it's the most expensive form, would be equity. Try to mix it at a later stage, depending on your business model. Think about convertibles if you need to bridge it to the next round.
So maybe to answer this, I think it all depends on where you are in your journey. If you really want to raise a couple of more rounds after a need to raise a couple of more rounds, then maybe it's not good to take it up too early, even if you're well suited for that already. And you should never forget, basically, that always debt always comes with covenants, and venture capital comes with as a partner. So, and this is a very big difference, and you have to see when to choose what in the end. You're sure it's always the trade-off, basically being diluted. That's for sure. But it comes not just the dilution; it comes with also an add-on. On the other hand side, you come to a very limited structure in the where you can't move a lot in the end if you took down debt structures. It's different for working capital financing in some cases, but if you think about venture debt, comes really with quite some covenants, which can limit also your ability to change, your pivot, and also to grow potentially.
I hope the answer was good. Awesome. Okay, next question. Maybe somebody is wanting to raise hands. Okay, SEO.
First of all, thank you very much for the podcast, or like the host so far. Really enjoyed the discussions between the VC perspective as well as the startup perspective. I actually have a question a bit more operational about your experience, especially Arnd. When, in your experience, would it be more useful also to start looking at accrual-based accounting that you would, for example, also get from your tax advisor? Maybe also very interesting to your perspective on this, Christian. And as a second part, I would also be interested in what is your experience into how often you need to revisit your financials, for example, monthly. Is it really necessary to prepare cash-based accounting weekly, even if it just means exporting your Konto transactions and then just assigning accounts maybe? Or is it also enough if you do this monthly or even quarterly? And maybe especially you all, what is your experience? How real time do you actually need the financial data to make sense?
Let me start at the beginning and then hand the mic to Christian. I think the question on getting special advice, be it special tax advice, special accounting advice, you won't have it in your founder team or in your first employees. So I would tend to outsource that. Same goes for ESOP or any structural things that you're doing at the beginning. You want to set it up properly and don't revisit after a while. I think the question on tools, I would rather push it out. I heard Excel before. That's how I did bookkeeping in my first startup. And I felt super comfortable because I could really handle it, whereas I probably couldn't have handled any type of more complex ERP software, and I would have spent more time on understanding the system than just getting the output that I need to get. So from that side, I would go for that simplicity. On your question on how often do you need to export your data, I think it depends on your situation. If you are in a crunch for cash runway, you want to do it daily. You want to see how the money is coming in. You want to get a feeling for how people are paying you and what are the terms that you need to pay. So clearly, if it's a more difficult situation, you want to be on top of it daily. On other data, on normal times, it's probably not necessary. It's probably better if you focus on doing the business than trying to do an overkill on data and data or how you show data. And so from that side, trying to understand how your business is going, how the unit economics are going, would make much more sense than trying to do a weekly P&L, a weekly cash flow, or even bi-weekly. I think monthly is a good time to do it. Just understanding, is everything that you're assuming about the business, is that right? Look at the things that are still incoming invoices. Have you provisioned for that in the right way? But don't overdo it.
Not a lot more to add, but I think you would really make it depend on the frequency of your business. So if you have basically, or you have to cost, you have to pay salaries, you have to pay rent, and those kind of things once a month. And if your business is happening once a month, then it's maybe enough to check once a month. But if you have hundreds of transactions daily, then it makes sense to check daily on your cash at least, so because cash really matters a lot.
Yeah, maybe commenting on the question of when to work with cash or relying on that data. I'm personally, and we as a company are actually big advocates of working a lot with banking data. The reason for that is it's always available. And like your financial statements typically are not. And of course you can push your finance team as hard as possible, or your external providers, to deliver these as early as possible. But still, typically it then takes like 10 days or so at the end of the month until you have it, whereas cash data you always have. And depends on what you're looking for, but like there are tools out there which can give you actually pretty good cash-based P&Ls, for example, which of course are no real P&Ls for obvious reasons, but ballpark give you a good understanding, and you can always have them like as flash numbers on a daily basis. And I think that's very helpful, at least from an operator perspective, if you want to get a sense for it. And I personally can't really understand why, like, it's 2025, if somebody is not able to log in at some place and see immediately the liquidity situation. I don't really know why. There are solutions for that.
Yeah, thank you very much. My question is more on a higher level. How do you see the fintech funding landscape developing in the next 3 to 5 years? And in general, maybe even funding landscape altogether.
Obviously, fintech funding has been down quite a bit since 21. I just had to pick out the numbers. So in 2021, there was 19 billion invested into fintech companies, and last year it was only 5-point-something billion. So it has really gone down significantly, actually. And now good news is that the trend has reversed, and in Q1 looked much better. So big increase of funding. That's good news. So it's very general. But in terms of what topic, I mean, obviously everything is AI today. So basically that matters. That also triggered the increase of fintech funding in the first quarter of this year. And we at least believe that this trend will continue.
And I would add to that in general, there's always funding available for the right kind of ideas. And probably looking at bigger B2C brands that might be a bit more difficult in getting funding, but nice and neat B2B tech-savvy type of innovations that can integrate into other business models that produce sort of a recurring revenue stream, the SaaS space. I think there's still plenty of room for fintechs that should get funding. Valuation is always cyclical. Sometimes you see multiples going up and down, and obviously that will make a little bit your dilution, even though probably Christian would say that in early seed rounds, it doesn't matter that much whether multiples of creative companies are in which part of the cycle they are.
I agree. I would say, like in general, we see a pickup compared to like maybe 2 years ago. So certainly more activity, and the later stage it gets, the less activity there is. And I guess it also has to do with what we talked about earlier, that for late stage companies, exit opportunities are still something where you don't see too much activity. And obviously, as an investor, when you're like more investing in the later stages, closer to a potential IPO, so you might be more cautious. Whereas as a pre-seed investor, there's like 10 years ahead of you, and the whole world might change until then.
I hope this answered your question. We have another one here, right on the front.
Hello, thank you for the discussion. I'm a big advocate of financial literacy, so I've seen a lot of stuff which is really weird on the P&Ls. So I think a lot of founders could benefit from the Excel spreadsheet. And my question is on the other side of financial excellence. So how do you see risk management at KYC evolving? So how did it evolve before, and how do you see it heading towards?
Maybe a few observations. Like I still remember, and probably the N26 folks who were here in the very early days also do remember what you needed to do like 10 years ago in order to open a bank account, and what technology was available back then. And I would say in that context, a lot has changed, and it's easier and it's more digital and more reliable, which is certainly a good thing. Other than that, I'm actually not the biggest risk person, and can't give like too much professional comments on that. I would just say, as a fintech company, you obviously need to be a bit more cautious in that area than like in certain other verticals. And that's something that I would encourage everyone to do. By nature, if you are in a regulated market, you should never assume that what you intend to do is actually allowed without any permission. That's particularly true if you come from the US or the UK and then want to build something in Germany. You're sometimes surprised. So for if that's good or not, we could have a debate about that. But that's at least something I would see as the bare minimum, what you should always do irrespective of the stage.
Actually, I haven't got a lot to add. I think there's, as you say, on KYC side, there are so many more digital ways of doing it in the past that gets you into a far better position. There's so many data points out there, what you can see from the customer in an online world than what you used to see in an offline world. How to use that, how to use the technology, how to use machine learning or AI algorithms in order to understand your customer, not only from a formal side, but also from different data points. That is a big help compared to the very early days. And you should have the right kind of tech stack to help you to utilize that.
Okay. There's so many founders here, so many startups. A lot of people of you have maybe thought about some questions on the right here. Or when I would be here, I would definitely think about what kind of financials are triggering me the most right now in my current situation. Maybe there are still some questions or some hiccups there.
So at first, also from my side, thank you very much for the discussion. It was very interesting. And my question is about like fundraising. I think all of you founded companies in the past, and how do you figure out when is the right time to get a fundraising campaign to start, and what are generally your learnings from that?
Well, in some cases, you just need fundraising to start the business. Obviously, then you need to raise right away. If you have the luxury of basically deciding whether you want to take or not, then really depends on what you want to achieve. I mean, the best way obviously is if you're self-funded or don't need any external capital, then you're maybe good off. But maybe you're leaving options or basically not maximizing the potential of your business, and that's why you would then raise more capital. So, and that really depends. And I think nowadays at least it would make sense to start as early as possible. So if you really in need of capital, want to achieve something, rather go out early, because it takes some time. And if you're not 100% fit of what the current appetite is, then it may even take longer because you need to find the right investor. But every investor would take something maybe. So that's why it make really sense to go out. If you're in need for capital, I would rather basically plan for 9-month period to raise. Can be faster if you're in a very hot sector. If you're something with AI, it's getting very fast, then it may be much faster within 3 months. But if you're not, I would rather plan for this 9-month period. Just as a rough idea.
I would say, or maybe an example like from us as a company, the last round we raised was a Series A, and the next would, if we were to raise around, obviously a B round, and even though these letters can sometimes be confusing or misleading, in that context, I would still say like for a B round, the natural thing that I as a founder and we as a company would need to show is our capability to actually deliver a commercial rollout. Like what we did in the past is we've shown that we can ship a product that customers love. We could report the metrics on that, which in that context, obviously revenue and unit economics and so on. But what we've not yet proven back then and what we're currently working on is, can we actually replicate this big time? Like, can we not only do this in a small niche in Germany, but can we bring into other countries? And if the story I'm selling in a fundraise is, for example, around expansion and accelerating growth, then I should better have some proof points why I can deliver that, right? And that's like a bit the framework I would always apply on that. And probably it's also true in the later stages. I've never run a company and it's such a late stage, but I'm sure there are similar things that you want to report or reasons why you raise capital and what you need to show then in the first place.
I think probably in all stages, you are in a way constantly fundraising or in a fundraising mode. What I mean by that is obviously you have specific funding rounds that you do, the seed and Series A and onwards, but keeping that constant dialogue with people from the investor side is super important for a couple of reasons. Number one is you want to get that feeling, how are those people, if you develop a constant dialogue, it's not a one-off time situation. Also, you want to make sure you want to work with those people going forward. On the other hand, you can onboard people slowly. You can talk about your business model and get their feedback, which I think is a super valuable feedback as well. You want to make sure everything that you're developing, obviously you have the customer is giving you feedback, but also getting the feedback from the investor around understanding how they look at things, whether you're on the right track or not. So I think my piece of advice would be keep in constant dialogue with a group of investors. Make sure they understand what you're doing. Make sure you understand how they tick. and have used them as a kind of sounding board on the way as well.
Okay. Question answered, I guess. Is there still some question? Okay, let's see the last one.
Hello. Thank you again for offering your time in this lovely space. I guess questions for Justin and Arnd. At what stage of company do you think the companies need a full-time CFO? And what are the different qualities in the CFO that a startup need, depending on the stage?
I think if you have someone in your founder team who's financial savvy, that helps. Obviously, you want to look at the right kind of mix, and you probably have people that come more from a product or engineering or customer side. But if you have someone who's financially savvy, they're always those financial admin, HR type of topics. So I think that would be a great opportunity. I think that role evolves over time to what probably is more understood as a CFO. When you go more into reporting, investor communication, controlling, treasury type of activities, maybe then you need a different type. But I think at the beginning, if you have a mix of people, and even though it's not a true CFO, it's more a business partner, it's more someone that does more operational type of stuff, maybe a combination of CFO, COO. I think that would be good in a founder's team. And then I don't know whether there's a yardstick if you have 100 people or Series B, something like that, whether you need a proper CFO. I don't think there's a clear rule to that. But clearly the role of CFO evolves over time, and getting that degree of specialization, someone that only does CFO and not anything else. I think you need it later in the development.
Maybe to add, I think you should have someone from the first day on who takes care of the financial, of the data. I think that's really important. So that needs to can be external, but someone in the team needs to take care of it. Not necessarily with a certain title, but so that can develop over time. And I would say, if you're still in the development phase and not generating revenue, then probably you can stay for a certain period of time for just having someone who takes care of the financials. Once you start developing or basically scaling and do revenues, I would say you need to someone who is more maybe educated, maybe even internally, maybe not as a CFO, but as a VP or someone at least who is there constantly and observing the cash levels, the business, and so on, all these kind of things. And then it depends really a bit whether it's already with the A round that you need a CFO or at the B round. It depends a bit on the complexity of your business and about the kind of financing involved or not. But make sure that you have really someone who takes care of your financial data from the first day on.
Maybe as a reference point to that, I would say, like, for the companies we have on our platform, and the average company has around 5 million in annual revenue, very few have a CFO, but almost every company has someone who looks after corporate finance matters. If not, we rarely see that.
So maybe to extend this question real quick, if they don't have a CFO, is there, as you maybe said, a VP, basically, protocoling and having meetings, Joe fixes with the founder and with founder team still, or how do they handle that?
I mean, ultimately, the question is, what's the difference between a CFO and a VP finance or a head of finance? I mean, maybe you have comments on that. What I like a talk I've seen 2 years ago or so from back then Emmanuel, the CFO of the Delivery Hero, when he talked about what he's doing on a daily basis. I thought, like, interesting. This is actually half of what I'm doing, and I wouldn't describe myself as a CFO, but it's a different thing. Like, if it's a publicly traded company, and he was just talking about the equity story. all day long. Like this was the only thing he cared about. For that, I would say, like, to the degree he was thinking about that, that's certainly completely irrelevant in the earlier stages and should be something the founder is looking after. So I think it depends a bit also like on ego in some cases. If there is a great candidate and you want to have that skill set, but that person doesn't want to join without a C-level title, maybe you wanna do that then.
I think the only thing I would add here is there is sometimes a difference between a C-level and VP, and I think it depends on how people are interacting. In certain situations, it becomes more and more important that a VP of finance is not only pulled in on a reactive basis when there's a certain question. You want to have someone thinking about everything that you're doing from a financial side. And what I've seen in other companies that have been too late in hiring a CFO, sometimes they were surprised or there wasn't a good exchange of within the C-level and the VP of finance. So there was a bit of that the VP of finance only knew bits and pieces of the puzzle, not the full picture. And that's where it wasn't optimal in terms of taking financial decisions. But I agree with you, it's not a question of title, it's a question of how you're embedding finance and how inclusive you are and the way you're running the company.
All right, we could take one last question. Otherwise, we would end this Q&A right now and get to the more unofficial part. We have pizza here, we have a lot of drinks, alcoholic, non-alcoholic, right here at the corner. So feel free to grab some and let's have some great discussions in a one-on-one. And thank you very much for attending. Thank you very much for the panelists as well. Maybe a little clap for everybody that they're super time here.